We've got DoorDash today. We got Airbnb coming. Are you a buyer of the IPO?
I am not, Andrew. I think, these are companies coming out when we got zero interest rates, a lot of momentum, peak market valuations. And you look at a DoorDash, I mean, Leslie just mentioned, look at the competition with Uber Eats, Grubhub, Postmaster, Caviar. And you're at the stay-at-home story. So what happens when we do reopen? What happens when restaurants push back and say, you know what, that 30% you're going to get is going to be much less because we can actually sell to customers who walk in. So I think people have to be very careful when you invest in these companies. Great top-line growth, but you have to look at margins, look at cash flow. That's what's going to matter in the next 3 to 5 years.
You feel the same way about Airbnb?
Well, I think Airbnb is an interesting story. I mean, you're playing two sides of it, right? DoorDash is the stay-at-home, and then Airbnb, you're playing for reopening. Now, again, valuation is going to matter, and people, if you're going to say people are going to travel, going to go outside, you really have to look at the valuation again, and I think it's pretty extended on this one too. And what is going to be that growth rate for those companies? There are a lot of other values in the transportation hospitality sector. I mean, we like Delta. Delta's cheap on a cash flow basis and knows how to run its business. So you really have to be careful because I think there's a lot of fast money in these stocks, especially with the pricing of these IPOs.
Let's talk about an industry where there's a little bit less fast money. Some of the traditional big banks, I don't know if you heard the comments that Jamie Dimon made yesterday, not just about interest rates, but about his expectations for the economy and for just potentially that maybe some of these banks are over-reserved effectively against a worst-case scenario. Would you buy banks right now?
Andrew, that's our biggest position actually as a sector. We're about 15%. Versus about 10 on the S&P. So we do own Jamie Dimon, we own JP Morgan, we own Bank of America. These are some of the big banks. We feel not only are they over reserved, but they've got great balance sheets and they've been able to expand operating margins, grow their wealth management businesses, and these stocks are trading at 10, 12 times earnings, a little bit over book value. I can throw Morgan Stanley in there as well. So we think that's kind of where the value is. And you saw in November, just in November only, financials were up 17% versus the S&P that was 11. So you want strong dividends, you got capital reserves, and you're playing a reopening story, and you're seeing the IPOs like Airbnb doing that. I think a place that you're going to do well is the banks.
Well, so how much room to move is there? If you were to look at these bank stocks on the whole 12 months from now, what do you think the upside is?
I think you...
And by the way, what do you think the downside is?
So talk downside, right? So downside is that the bridge to reopening is longer, provisions are more, and the 10-year comes back down, so the spread interest comes down, and M&A activity slows, and then the bank's also wealth management business slows. That's the downside, right? The base case is rates now are the highest spread that we've had in many years, even though the 10 years at almost 1%. But the short-term rates, which the Fed has said they're going to keep short to zero, are going to be for a while. And as M&A picks up, and look at the capital markets activity, all these banks are participating in these capital markets. When we look at Goldman, Morgan Stanley, JP, they're all underwriting these things. And all of a sudden, their rate of growth, Andrew, is going to be better and higher in the next few quarters. And that's what investors pay for. They want acceleration growth. They want cash flows. And the banks have not been allowed to buy back any shares. They haven't been allowed to increase their dividends. So there's a great opportunity there. And what you're going to see, we feel, is the leadership change, and you've seen that happen the last 4 weeks. It's 2 steps forward, 1 step back. We get a negative reaction of the market for something, but there's a good opportunity there. You can add, asset management firms there like Blackstone and insurance companies like Prudential, and I think you put a diversified basket together, you can do well in this sector that has just been underappreciated and unloved because of the reasons that Jamie talked about.
Shepard Smith here. Thanks for watching CNBC on YouTube.